Morning, legends. Hope you're all doing super well on this amazing Monday, the 20th of March. Happy birthday for all those people whose birthdays it is. Random call, but it was mine just yesterday and had a wonderful weekend down here on the peninsula. As you jump into the chat, let us know that you're in there. Put your name in the chat, where you're coming in from, where you hail from, and let us know what's on your mind, what you're thinking about, what's going through your head at the moment. Is there any news that's particularly captivating you? You're turning off the channel. What are you looking at? Be good to know what your thoughts are on this amazing Monday morning. If you're driving, drive safe, obviously video off and all that sort of jazz. What I'm going to chat with you guys about today is the reason why I'd hate to be the head of the Fed right now. And for those of you who are on coffee chat, let us know. Remember what the topic was about, because it's going to dovetail into that. Alex, great to see you. Welcome. We've got a Facebook user in one of our groups having a coffee with us this morning. Oh no, I can see what's coming. Good morning, Debs. The amazing Deb Jensen's here this morning, and here we go. It wasn't going to take too long before somebody was going to give me some grief. Yes, I thought the boys might turn it on and give us a birthday win, but the Hawks got decimated by the Bombers. Congratulations! I even went to the footy on Friday night to see Geelong play, and Geelong actually got beaten by Collingwood, so it was a very unexpected round. Not saying that the Bombers winning was unexpected, but for many of you, you don't care about that. You're more interested in the wine man. It'll be coffee this morning, mate. It's a little bit too early for that. So, team, going to chat with you about the reason why I said why I'd hate to be the head of the Fed right now. Give you guys some practical tips as to what to look for over the horizon, where to find some of the information to do that. Morning, Alison. So the reason why I say I'd hate to be the head of the Fed right now is many of you would have been on Friday's session. If you're not, you can always go back and check it out. And we spoke a little bit about bonds and how interest rates rising decrease the value of bonds if you're to sell them in the open market, and also as to the reason why Silicon Valley Bank ultimately met its demise through lack of, well, basically failing banking 101. What we're going to run through today and what I'll take you through is a few little tidbits. I've got to remember to bring up my second screen as well. Thank you, viewers, for letting me know. One of the things that I'm going to chat about today is, well, there's a lot of press going on at the moment about Credit Suisse. We can talk about that later on in the week if you want, if it's something that you're interested in. But ultimately, there's a lot of conspiracy theories going on. There's a lot of fear there out in the markets, and just want to look through some of that for a moment and give you some technical insights as to what the market thinks is going on, not what the media commentators think are going on. Let me know if that would be helpful for you. Whack a yes in the chat or a Y in the chat if you reckon that might be useful, and we'll get cracking into it. Good morning, Aaron. Great to see you. And Alexis. Lexi, good to have you on board. Right, so looking up my second screen for you all. Where is it? It is just here. And this is where the inflation data is for the moment, and where the expectation of future interest rates are going to be, and chat with you. These are all this is a statistics discussion. Everything that I'm going to take you through can be found either on the RBA website or some of the bureau websites. They're all quoted here, so you can have a look. But ultimately, at the moment, for those of you who don't know, current cash rate in Australia is 3.6%. And you can see here, it's gone on a reasonably rapid increase over recent times, come down from a fairly significant height back in the day in the 1990s, just post the bicentenary in 1988. Anyway, what bond yields are, and I'll dovetail this back to Silicon Valley Bank and the mismanagement of bond yields, because remember we spoke about when bond prices, when interest rates go up, bond values come down if you want to sell them into the market. They don't lose their value if you hold them; they maintain their value until maturity. So if you buy a 5-year bond for $1 million, it's worth, they'll pay that $1 million back to you at the end, plus whatever the interest rate is. But if the interest rate is lower than what you could get in today's market, well, you probably buy a bond today instead, or you buy that other bond at what's known as a discount. So all other things being equal, with banks holding large amounts of treasury deposits, and this is where I think Jerome Powell's in a bit of a tight spot right now, is that when we have this dynamic here of interest rate rises, and we might go to the US actually. I'll take you through the US stats. No, I won't. I'll stick with the Australian stats to explain this. When interest rates increase, like they have here, and the banks have, billions of dollars worth of government bonds, well, ultimately, if they want to sell those bonds into the market, they're going to suffer a capital loss. Right. So if they need to deploy that money and they need to sell down the bonds, they're not going to get what they paid for them. They're going to get a lot less. A lot less. Now, the question is, for how long? Because if Jerome keeps on raising interest rates right now and continues to raise them, then in theory, the value of those bonds will actually drop further. So we're going to see more pressures on the US banking system, more pressures on the global banking system based on interest rates rising. Now, that's a very natural dynamic to happen at this point in time. And the hope is that banks are actually managing their duration risk. I won't go into detail about what that is, but ultimately, at a very high level, it's how long they're committed to their bond portfolio. So if they've got a lot of 10-year bonds, it means that they've got investments that have got 10 years to go. If they are invested in 1-year bonds, it means they've got investments with 1 year to go. But we want to look at this and see, well, how long is this problem likely to be around? And the best way to figure that out, because if interest rates continued to skyrocket back to where they used to be back in the days pre-Gough Whitlam, now look, that would be extraordinarily challenging for banks, and we would see some serious issues happening around the banking sector in the globe. Very, very serious issues. But the data that we're looking at the moment doesn't necessarily lead us to that conclusion. So what happens is the media tell us about things that are going on today, and talk it up and ham it up, and quite often talk about a very poor future into the future. But ultimately, the market's not telling us that this is going to be as significant a problem as what it is right now. And the reason why I say that is markets are actually predicting that interest rates will actually plateau and come off rather than continue to go up. Right now, we can't guarantee this, but this is, I'm going to take you through the 5-year bond yield in Australia. And this is a sort of a predictor by market forces of where they believe interest rates are going to go. So as you can see here, over 5 years, we're just a little bit above 3%, which is off from the top. And we didn't quite get to the 4% here. Right. So actually predicting that in 5 years' time, if you were to buy government bonds right now, 5-year government bonds, you'll be paying a yield which is just a little bit over 3%, keeping in mind that the current rate, 3.6. So the 5-year bond yield's expecting it to come down. So what we do is we have a look at the bond yields and we go backwards in time. We go, well, what about 2-year bond yields? Where is that sitting? It's almost in exactly the same place, just above 3%. Give me a Y if you're following what I'm saying in the chat, because this is going to go to your mortgage rates. It's also going to go to your confidence in the banking system. And I'm also going to take you through how you can utilize some of this dynamic to better understand how you can get more money back into your pocket when certain events happen. So if you want that, write a yes. Let me know that you guys are all still engaged and connected. And as long as you're not driving a car, if you're driving the car, focus on driving the car. Right, so that was the 2 years. And I went back a little bit further and look at the 1 year. So look at that. That's market. Thank you, Luke. Another Andrew in the house as well. Thank you, mate. Appreciate you guys participating, letting me know I'm not on the journey alone over here. Awesome. Alexis. Who else have we got? We've got David in the house. Oh, yep, they're all coming through now. Magnificent. And thanks, Dave, as well. All right. So ultimately, market forces, not RBA setting the cash rate, none of that sort of stuff. Oh, thank you, team. Everyone's lighting up now. It's amazing. Everyone's on the journey. The market's really predicting here that within the next year, interest rates in Australia will actually start to drop. Right now, this has got nothing to do with the Fed right now, and I'm going to link the Fed back in a minute. But it says, within the next 12 months, we expect the market expects, based on the bond yields, it expects the market to drop from a high of just short of 4% to around about 3%. Right, that's still what's happening. So let's have a look at the US, right, and then I'll bring it all together in a minute. The US current cash rate 4.58%. So the 1 month bond yield has it basically at the same amount, but you can even see the 1 month it's actually looking like going down a little bit. When we jump out to the 1 year, it's still above 4%, right? Because ultimately what this is showing is over the 1 year, it expects it to basically peak out at around about 5%. Now, this is where Jerome Powell, thank you very much, has got that issue. Wonderful coffee. Sorry about the slurping noises. That's magnificent. Thank you, team. So this is where Jerome has a bit of an issue, right? So there's this period of time in here, if we believe that the market's correct, that Jerome's got to make decisions whereby in history, and this was back in the early 70s, the Fed, being the controller of US interest rates, almost got inflation under control. And then, so they tapered, so reduced raising interest rates. And what happened is all of a sudden inflation went bang. And what happened? So inflation was going like this, and then it curved off. And so they lowered rates. And then, they kept rates on hold. And then inflation jumped again. And so they raised rates, and then it plateaued, and then they plateaued. And then that went in this dynamic, and it basically went from about 4, I think, to about 13%. Don't quote me on that, but it went very, very high. So the Fed is unlikely to stop raising rates until it gets inflation under control. So we're going to chat about inflation in a moment. So this next period of time, for the next 12 months, where the market believes interest rates are going to go up and go up to 5%, and at the moment that's another 0.5% rise, that's going to put more pressure on US banks, right? So you can expect to see a lot more, and global banks as well. And we might even talk about a thing called contagion. And I don't mean about coughs and splutters contagion. I mean contagion in financial markets terms, where defaulting of one institution rolls on to put pressure on others. Right, so this is where Jerome is going to have to make decisions, and he may choose to make the decision to continue to raise rates, which means that the assets of banks will continue to fall. So that puts pressure on banks offshore, right? And the US have shown that they'll look at bailing them out. But now let's have a look at the 5-year bond yields. And now we're starting to see a significant drop in where the market believes that they're going to be. Right now, that's a little bit higher than 3.5%. So ultimately, the market believes that these interest rates are going to be transitory. So the media talks about things that are happening right now today. Great. But the question is, how long is this issue? Because how long do we need to manage these liquidity crises, or these insolvency ratios, as they're called, when the bank's theoretical value of their bond, if they were to sell them in the market, is worth less because of interest rates? Whack it at your why, if you're following me here. It's a complex concept, and I reckon you should tune into a Wealth, Wine and Wisdom one day on a Friday night. Listen to Jason and I. If you're curious about it, whack it in the chat, where we can spend a few hours talking about it, or an hour talking about it. So let's have a look at this. We know that we believe that the US Jerome won't want to stop raising interest rates until inflation's under control, right? Because ultimately he doesn't want inflation to run rampant for the next 5 years. So he's really wanting to control that, and they control that via raising interest rates. So how has that affected interest rates over the last 6 months or so? Sorry, how has that affected inflation? We can see this is the monthly inflation rate. So it looks back 12 months to see, how much inflation rates increased. So we've been up at 9.1%. The US targets a 2% rate, right? So targets it to be down here, right where my head is, just above my head. So you can see that since May 2022, right, we've had a fairly significant decline, and this is really to December, of the inflation rate actually coming off in the US. Now, that's a great sign. That's a really, really great sign. Now, the question Jerome is going to have to ask himself and all of his team, it's not just him, but he's the scapegoat. Sorry, he's the chair. He's going to have to make the decision, do we continue to raise rates and put pressure on the banks, but potentially allow inflation to pick back up again? Or do we allow and put pressure on the banks to pull inflation back under control because it's working? Like, that's a tick at the moment. What they're doing is actually working. And that's the reason why I'd hate to be him right now. And hopefully he gets a lot more support. And he already is. There are a number of measures that are coming into the banking system over in the US to try and make sure that the liquidity and the fundamental backing of the treasury securities, which the banks own, continue to stack up and ultimately mean that the banks can continue to be solvent and trade well into the future. So this is the dynamic that the Fed in the US are looking at, and this is what they're having to look at controlling. So the question, or really what I put back to a lot of the media at the moment is a question is, well, a lot of what you're writing about is correct fundamentally. Some of what is being written about is correct at different layers. The question is, how long is it going to last? And most of the indicators that we're looking at mean that inflation is coming off and interest rates will stabilize and look to even come down, both in the US and Australia. That's what the data tells us. It's not always exactly what happens, but look, that's what the statistics look to tell us and what the market does. Right, so that's a little bit about why to be a shit position to be if you're Jerome Powell right now. Tough position. Everyone's going to hate him anyway, so hopefully he makes good decisions. It's a pretty thankless job. We can talk about actually, just one more thing. The reason ultimately that really I think that he's in this position as a result of himself and the reason why banks like Silicon Valley might have got caught out. I mean, they did mismanage their banking and, fundamentally broke a lot of the 101 banking rules of diversification and duration management and things of that nature. But ultimately, as the Fed is usually quite consistent in times in the pandemic, and so did the Reserve Bank of Australia, I think one of the fundamental flaws or errors that they made was that they gave the indication that rates were going to remain low for an incredibly long period of time. Now, both of them did it. I'd almost argue that one probably did it because of the other. Now you can try and figure out who that was, whether it was whether it was on our side or whether it was Powell. I know which bet I'd take. But ultimately, that statement right there is where, if you believe that you could buy longer term bonds and believe that you are going to have them very secure over a reasonable period of time, that's one of the fundamental mistakes I think that they made in their announcements during the pandemic. So let's bring it home to you guys, and then I'll let everyone get into their day. Hopefully you guys have learned a little bit about what it might be to be the chair of the Fed. Not a great role right now, as I said. But how can we take advantage of these types of movements over time? And you might have seen this chart. I know Jason and I have spoken ad nauseum about this over time. What we've got here is the RBA official cash rate, in red down the bottom here, right? I might move that a little bit to the side. There we go. Then the blue line, right? And this is an interesting period of time. Let me ask you this. Who can tell me why the blue line, which is the standard mortgage home loan rate, and the green line, the discounted variable rate, who can tell me how these two came into existence? Be interested to know. Whack it in the chat. So I'll talk to them a little bit. The standard variable rate. Well, let's have a look at the correlation. All right. So the correlationship between the red line and the blue and green. And what I'm looking for over time, have they stayed closer together or have they moved further apart? What does it look like? So they started off at one point in time. The gap between them was it's not very much. But let's have a look at these gaps here. And what I'm talking about are the gaps here. Have they become smaller or have they increased? Alexis, 100%. They have, Lexi, they're further apart. And what this dynamic is, as the Reserve Bank of Australia lowered rates, and if you're listening to Jace or I, we were saying, yep, 100%, Alison, they've increased. So what happened was, as interest rates dropped, you'll probably remember this. They said, reserve banks have dropped their interest rates, and they passed on, 50% of that rate drop. Right now, every time the cash rate dropped, the banks made more. Show me the what? Show me the money. The banks made more money as the interest rates dropped, because let's just say the cash rate dropped by 0.5%. The bank might have passed on 0.25%. All right. So what we had over a period of time, if you were loyal to your bank, then ultimately, and you didn't press them to get a better rate, then ultimately the bank profited more and more off your position over time by your apathy or your desire not to do the paperwork, whatever it was, or maybe you didn't know to do it. But if you didn't, ultimately the distance between the two rates got further and further apart, which meant that the banks were making more money as the interest rates were dropping. So number one thing, don't be loyal to a bank unless you have to be. Make sure that you're always ringing up and trying to haggle for the best interest rate discount that you can possibly get. So coming back, nobody got the answer to this one over here, which was, why did the two diverge, the blue and green? Ultimately, what happened was APRA came in and there was an inquiry, and they brought in this thing called responsible lending. And the gap between the two meant that on a risk basis, they said potentially investment lending is more risky and they wanted to curb it. So what they did is they created an investment loan rate and a principal place of residence loan rate, effectively. So penalising property investors out there, which meant that you got a higher interest rate if you're investing if you had a loan for investment purposes. That's fundamentally what the difference of the two lines are. So what happens when rates go up? Well, look at these lines. They literally go up pound for pound together, right? If the cash rate is risen by 0.5 basis points, the banks are going to push the rise straight through, because if they don't, they're going to what? They're going to lose money. However, if we take notice of this, all right, these dynamics, and we look at, well, if we look over the horizon, we go, yes, for those of you who listen to Jace each morning and us on Wealth, Wine and Wisdom every Friday, you'll already be in a position where you're building your buffers to cater for rising interest rates. What will happen is interest rates plateau, when they plateau, and then when they start to fall, this is when you should be going back into the banks, looking for your discounts, looking for them to sharpen the pencil, because ultimately that same dynamic will likely play out, but just in a slightly different way. So some of the things that you should be planning now is going, okay, well, while rates are rising, make sure that you've got the sharpest rate that you can in the market, and you can always look to try and get sharper rates. But as interest rates plateau, and then as they start to decrease, this is where you need to be onto your banks, onto your brokers, and make sure that your position is one of the sharpest that you can get. So get prepared for it. It's going to happen. It's just a matter of time. When, where, that's the hard part to figure out. Hopefully that the market is right, and that this is going to get under control within the foreseeable future. Certainly, we'd love it to be that way over here. Support Jerome in his decisions, or don't, whatever you want to. But he's got some tough choices to make right now. But ultimately, he'll be making them understanding as well that the market believes that position is going to change because it's already working, as you can see here. And ultimately, they're going to really ask themselves, all right, what is the issue of interest rates going up and how much pressure is that going to put on the banking system from a liquidity perspective? No doubt they'll figure out some measures to try and protect the banking system from that. There may be some blood along the way from mismanagement, because at times like now, if you mismanage your risk, you can become very vulnerable. And that's one of the key things here, is that banks hopefully have been managing their risk well. Out in Australia, we've got the 4 pillars policy. We've got some of the strongest banks in the world. Very, very different landscape out here than what it is in the US. So if you try and put the lens of the US over on the lens of Australia, it's not going to work. Silly thing to do. Totally different system. And we need to look at it in a very, very, very different way. And perhaps we'll get into that another week. But team, understand these things come over periods of time. We already know where the market believes the interest rates are going, and all of you would have already planned your buffers according, and making sure that you're managing your money with that in mind. But also understand that over the other side of it are opportunities to take advantage of potential rate drops in the future, and make sure that you're on the money when that happens, because likely the banks aren't going to pass it straight on. They're going to make you work for it. So team, hopefully that's given you a bit of insight into some of the statistics. I know it's a bit boring to start a Monday talking about inflation data and interest rate data, but there was so much on about the banks over the course of the weekend, and in every newspaper. I thought that it's prudent to at least put the statistics out there so that you can make more informed decisions, or at least understand that these things are potentially a little bit more transient. We're not locked into an interest rate rising environment, for the next 10 years, at least hopefully not. That would be quite challenging if we were, but all things are pointing to interest rates either stabilizing or coming back down. We can see that this is working. You're probably feeling in many ways that this is working. And what I mean is that, inflation is starting to come under wraps, because the cost of things have gone up. People are going to stop spending as much. I know that I felt it on the weekend as well. And most likely we all will. So you will feel it, you will see it, and this is how to manage it over time. So team, remember, put some points in the diary for your mortgage checks. I think that everyone should every single year review their mortgages. If there's one key takeaway that you take from this morning, is whack it in the diary, put it into your calendar, put a yearly reminder in, and make sure that every year you check it out, and that you make sure that you've got the best rate that you possibly can out there. Otherwise, what have we got here? It's the good stuff, Mr. Wineman. Thank you, mate. Stay cool. I thought you were saying something about wine in the morning there, mate. And I was thinking, no, it's just coffee. But for now, gang, hopefully you're off to a flyer of a week. We've got another person who's going to be running a couple of these sessions later on in the week. So stay tuned to the amazing Sammy Saggers coming on and dropping some nuggets of gold. I'll see you tomorrow morning. For Jace, mates, hopefully all is well over there in Japan. And hopefully I'll bring you an update from Jace tomorrow. I'll make sure that he sends one through to us. So for now, team, have a wonderful week, and we'll see you tomorrow for another Wealth Coffee Chat.